Hi, this is Randy Finney with Right Side of the Chart, and this is a closing market wrap for Tuesday, October 22nd, 2019. I skipped the any videos yesterday as members. I told you I made a few posts on the site, but coming off a pretty nasty chest and head cold, maybe the flu. But turn the corner now, so we're back to normal with the videos. I may be a little nasally in this one still, but we should be able to get through it. I'll keep it relatively quick. Members, this will largely be a recap of the midday update I did on the broad markets today. Maybe a couple other items that I'll cover. I'll cover the ES chart. I don't believe I covered ES on the other video today, but we'll look and do a quick update here. So probably the most significant development today, a couple things. Later in the day we had a break of those channels. As I said in that video today, I expected we would break down. I said we've been getting pretty long in the tooth. To kind of back up, for the last week or so, my primary focus has been on the 60-minute charts, and namely on these primarily on these price channels here. These are all colored differently here. Forget about the colored lines. Let me show you the ones we're looking at. In case you haven't caught my analysis recently, you have an uptrend line right here. Missed that. Let me try it one more time here and get that line. I can't move them once I remove the release the mouse here. There it is. The uptrend lines right here, and then as so often is the case, you can put a line around, or in this case perfectly in the midpoint of the channel, that acts as support and resistance, and you tend to trade quite often either above or below, because that midpoint line acts as support or resistance. And so, as covered before, you had these series of gaps early on that separated the trading on the upper lower half, and then Friday we had a sell signal right here. That was an objective short entry because we broke it early in the session. It's not as if we gapped down, and that gave us a pullback trade. And at the time I said I favored a break down below that price channel there to hit this level, come in and kiss the top of the gap there, which we did, but then we had a perfect close right back on it on that 60-minute candle, and then as kind of talked about before, we'd probably just grind our way back up in the lower half of the channel, which we did. So that was then, and then earlier today, a couple things happened. Let's start out with the post that I put out in the charts I'm watching this morning. These went out before the market opened today, and so I said, and this is important, I still think, that I talked about how we're probably not going to see any big moves, any major moves in the market until we have these big three earnings reports out of the way. Microsoft will report tomorrow, Wednesday after the bell, and then followed by Amazon and Intel Thursday after the bell. So what's going to happen is Microsoft will report, and there's going to be a initial reaction, positive or negative, on the earnings, but I caution not to overreact. I mean, that's not going to happen until after the markets close, number one. So unless you're trading in the after-hour session, it's not going to affect you. But you'd need to consider that whatever positioning you go home with, long or short, that the odds for a gap for or against your position are increased because you have one of the largest, in fact, the largest company in the world, or number two market cap. Only Apple and Microsoft are in the $1 trillion club. And so Microsoft reports after the bell as a top weighting in both the S&P 500 and NASDAQ 100. It can most certainly move the needle on the indexes. So look for that. And as I often say, now I wouldn't read too much into the initial reaction. The company first releases their earnings, their financial data, earnings per share, revenue, all that good stuff. Then it's followed by the conference call where they will give forward guidance, and that can turn things around. So I've seen stocks shoot up in after hours on an earnings beat or plunge on an earnings miss, only to see the stock pull a 180 and go the other way based on the guidance. So just take that with for whatever it's worth. Is you'll want to really wait and see until you probably have a good idea, unless Microsoft closes the after-hour session down 8-10%, some big crazy move. It's very unusual, but I've seen it make moves like that before. That's about an extreme, really, for a company of that size. But my point is, you'll really have a good feel on Thursday when the starters, the institutions, the big players step onto the field. They can't maneuver well in after hours. There's not a lot of liquidity for them. So really it's going to be Thursday, see how that one trades. But then on Thursday after the close, Amazon and Intel. So same thing. We'll have to wait for the dust to settle on those by Friday. Then you have the rest of the market moving FANG stocks, including Apple, reporting next week. So point is, the market will most likely, you're going to have the biggest companies, the highest weighted components, again, and not just the NASDAQ, but also the S&P 500. They're all going to have reported by next week. So we already had the financials out of the way. They don't move the needle. They can move the needle a little bit, but these guys are the needle. So we'll have a good idea whether this market wants to go on, pop to new highs, new all-time highs, make that marginal new high scenario I'm talking about, followed by a reversal, which is still my, like I would like to say, my more bullish of my two bearish scenarios, and the more bearish being that we don't make that marginal new high. Anything other than that, if the market rallies another 10+%, I'm just wrong, and it's going to certainly have the potential to change. The charts, but anything again 2, 3, 4, 5% over the previous highs is not going to change the long-term technicals. So we'll just see how things go, and we'll take it from there. So in that, I said that QQQ remains here. What did I say in that note? Remains to work higher in the channel. Next sell signal may come on a break below the channel, although it's unlikely to make any big moves until then. The next chart I posted, this one here, NQ. Let me get to my notes real quick on it. Okay, on this one, also posted before the market opened today, screenshotted, that's 8:49. I cited 9 reasons on this chart why I favor a pullback at NQ today, even though QQQ was currently poised to gap up at the open, which it did. So futures are up pretty decent in the morning, and at this point in time, I took this and we gapped up. But the reason why, here's my 9 reasons, and they were pretty much two of the same reasons here. 78.90. Why? 1, 2, 3. As I said, all these circles up here, these were all failures at the 78.90 level. It is significant resistance, and I expected at least one more pullback. Now we can pop it. The market's already had a big correction off there and it's pushed back up, and I'll tell you, I'm almost leaning that way. It's probably coin toss odds whether we're going to pop that in the next couple days. Usually when you get this close to new highs, I'll get to that in a second. Usually when you get that close, now again, that's usually you pop them when you get that close to new highs, but we could certainly fall just shy. Either way, for just today, short term, because of that reason, I wouldn't just say because we're at resistance that we're going to pull back, because sometimes I look for breakouts. I look for a bullish long side setup when you come to resistance if I expect it to break at that point in time. But down below, the other reasons, these circles I cited here, is I have this RSI. Actually, I use a 14 and 9. This was an RSI 9 setting on the 60-minute chart of NQ. And as I said in a video earlier today, most charts will default. They'll give you a line at the 70 level, which means indicates overbought, anything 70 or above. But as you can see here on the RS9 setting on NQ, the NASDAQ 100 futures, I put the line at 85. That's where the red line is. Why? Because that's about it. Once you hit 85, you've never stayed, at least back in last several months here, we've never stayed up there anything more than just a brief hit. That's the extreme overbought reading. And so you're overbought at resistance. Again, you have divergences as well. I didn't extend. I pointed out the fact we had last time we hit 79.80. I pointed out that was a divergent high, and there was your last, strategic, or tactical, I should say, tactical short pullback trade. It was good for at least a couple, 2-3 percentage points on NQ, and that's if you're actively trading, that's a pretty profitable trade. So we hit it again here, and we really are just extended. We're pretty much made a slightly lower high here on the RSI and a lower high on the PPO as well, so you just extended the divergence. So that's it. That's actually an extra reason there, if you will. So at resistance, extremely overbought with divergence, still just really an extension of the previous divergence or close to it, roughly an equal high there. And that's it. So we pulled back. That was then. That was this morning. And if I can find that chart here, it's it right there. Boom, there's your down right there. That is, if you're an NQ trader, that's good for about 1.1 3/4%. If you trade the NQs, I don't have to tell you how much that'll put in your pocket there. So, and then of course I said too that next sell signal coming to break at that trend line. That was in the other video today. And then, as I said, I favored that we'd probably go on and break these trend line, that price channels on QQQ. So there it is. And in addition, you were of course at resistance on NQ, so you were also at resistance on QQQ. You have this trend line right here off the recent highs, and a lot of pretty much this is where prices have stopped before. So that's just a very near-term sell signal. Where do we go? Probably down about here again. The top of that gap would be your next target. Maybe, here's what I think at most, because again, tomorrow is Wednesday. Microsoft will report after the close, and I doubt we'll drop much more than that. That'd be about another 1.2% from where we close. It would give you that gap backfill. Like I said, if this market is going to go on to new highs, if it's going to take out the previous highs on both SPY and QQQ, the bulls, if I was a bull and I was wanting to trade that scenario, and I thought we were going to new highs and much beyond, I would want this. Why? Because that would be a backfill, that big gap. That right now is what we call in trading unfinished business. If QQQ happens to turn up and go on and make a new high and rally, it's going to leave this gap here unfilled. That doesn't mean that it can't go up anymore. It doesn't mean the gap has to be backfilled. It just means simply that most gaps, like this one here, are usually backfilled. And you go down the line, that's common. So that, let's just say near term, if you are trading and you happen to get that tomorrow on QQQ and you shorted this morning when you were at resistance on NQ, or that trend line break afterwards, or this breakdown in QQQ and SPY, by the way, then you might want to cover if you get near the bottom of those gaps right there. Here's SPY, the comparable channel. As I said, the midpoint line, that's the thing, it fits real clean on QQQ. On SPY, you could put a midpoint line, but I tilt this one slightly, or quite a bit. That seems to be where you have the you can see the different clusters of trading. In other words, that's the line that acts as support resistance. Here's your clusters of trade candles there, you gapped up there, broke it here, and you were pinched. But then you had the breakdown today, and as I said earlier, either on that front page post or in a follow-up or maybe in the trading room, I don't know, it's all kind of blur, so I'm still a little medicine head right now. You had I said you want to see both QQQ and SPY break, and they did. And when they broke, this is another thing about technical analysis, and we didn't just kind of meander around after we broke down back and forth. No, we broke down, and you can see the two most impulsive red candles that we've had in at least several days right now. That tells you that was a well-watched technical level. It was support, and when it was broken, you can see the impulsive selling that happened. So again, if we didn't have Microsoft and Intel and Amazon on deck, I would probably say, this is a good time to, tuck away some swing shorts, hold on. Otherwise, no, not for me. I'm just looking for, at this point in time, it could certainly morph into more. I'm just telling you that there is going to be, you go long or short, you go heavily long or short into earnings tomorrow night and Thursday night, and even next week with some others. You're risking a gap against your position that may bypass your stop. When you trade futures, that's one thing, because they trade virtually around the clock. When you're trading QQQ and SPY, you're trapped. You have absolutely no control over your positions. You cannot use stop loss orders in the after hours session. You can only use limit orders. You can just stop limit, but that can be bypassed. Stop loss orders convert to market orders when triggered. There are no market orders in after hours. So 4 p.m. comes, that's it. Futures are liquid. I can go to sleep with a market or a stop loss order on a short or a long. And other than the brief shutdown periods after the close every day, they trade around the clock with liquidity. And so if there's a huge move, my risk is limited. NQ I know isn't for everybody. I like, if you I've been talking about the new relatively new micro E-minis. If that's so, if you're not comfortable with a contract of NQ that represents about I don't know, so 150, 160,000 per contract of exposure, you can use the MNQ, which has a smaller leverage factor, but still trades off these same levels. As I'm doing the video right now, you can see we're coming up to support, a pretty decent support. I know I have a lot of lines on this chart, but you can see here support. I have a line at 78.44 that we undercut it just slightly there on that last pullback, but let me draw it out here for you. Right there's that line. And down below, if we take that out, and this would probably align, a move down here would most likely align with that gap on QQQ that I told you about. Maybe the top of the gap. I'd have to scrub the charts side by side, look at them. But either way, if we take out 78.44 tonight or tomorrow, that would be a downside target. And that would be a spot that if we get there, and again, I'll also look at QQQ at the time, but that's most likely where I'll cover any shorts that I have at this point in time, if not sooner. All right, let's move on to ES and all that. But there it is. There's 78.90. That's where we were this morning. We were at 79.81, I think, when I posted that or so. And there's your impulsive rejection again off that level. So this is a level to watch. And likewise, if you're a bull, you break that out with all these rejections, a solid breakout above there should be bullish, because that's been tested so many times now. So one way or another, it's either an important level, maybe that was it, maybe that'll be the last time we ever test it, never look back, or we break out soon. And again, we'll probably know within the next week or two here, based on those big market leading tech stocks that are reporting. ES for you S&P 500 or ES traders. This is the ES 60-minute chart. It's busy, guys. I have a lot of trend lines on this one. Let me just highlight the most salient or key features here. We have the divergence has been building from this point. So I'm looking at the RSI right here. Here's your negative divergence. Here's your PPO. And yeah, we had divergence here. It's been divergence has been building for that. Not really here. This line, this one needs to go away now. We don't have divergence there. So let me just remove that one. We had flat line divergence down here basically, but here's your divergence line. You can see it clearly from this point right here with the RSI and PPO making a series of lower highs, while prices make higher highs. So you have divergence, little correction, divergence extended, a little bit bigger correction, divergence, that divergence continued to extend, and so far another correction or pullback, and we have a little trend line here, minor trend line support, but probably the biggest level is right here. You can see some support coming up at 29.84.80, and again, I apologize, this chart looks like a Christmas tree with all these lines and colors on it, but right there you can see that 29.85-ish support for ES if you're an ES trader. If that goes, then my focus is more on NQ, but I'll look at them both, but maybe down here. And again, that's all near-term stuff. Once these big FANG stocks report, we could see some more movement in the markets. Certainly, I mean, they have the potential to really, like I said, really take us up, to break us out to new highs, or seal the deal. The chart I alluded to a minute ago, or I talked about the the pattern of new highs is right here on the S&P 500. So here's a bigger picture, my S&P 500 daily chart. Like I said, any new high, any marginal new high, anytime soon will be a divergent high. Although, if it's much more than that, the potential to take out the divergence is there. So the divergence is right now we've been making a series of lower highs on the indicators, versus a series of higher highs in price. That's negative divergence. And should we push up, as long as it's only a marginal new high, and that's key. If we go up a lot more than that, what we're going to do is we're going to take out this previous reaction, or these previous reaction highs in the indicators right there, and then we could move these divergence lines up. But you start to do that, if they go up much more, they're going to be, the divergence will be negated or gone. It'll be taken out. In other words, you no longer will have a series of lower highs. So that is, again, where we go, to me, it's the same. It's pretty far down there. It's a matter of, do we just go up a couple more percentage points, or do we fail? Now here's the pattern that I've been talking about of the market making a series of new highs. Here we had a high back here. We had a big correction back in early 2018. We went on to make a marginal new high. What I mean by marginal? Well, just, slightly new high, slightly higher, 2.35%. So what I'm going to show you is every single high I'm about to circle was a marginal new high. None of them more than 3% over the previous one. This one was a little bit higher. This was just basis points, less than 1% above that one, but it was above it. Of course, this one was above that one, but less than 3%, and this one was above that one. What's the common theme? Every time we eked out a marginal new high, that was a high. We were making highs going in there, was followed by a correction, either from a huge correction or a pretty decent correction. Either way, they were all very tradable corrections, and that's a series. So you have a market that is really, from this point right here, over a year ago, that's September, the end of September, where we closed today, the market is up 1.52%, 1.5% in over a year. So here's a market that refuses to go down. I mean, it's had some corrections, but it also refuses to go up. And what we can say doesn't mean it can't keep doing this, but the pattern, clear pattern, has been that of marginal new highs. So look, I play the odds, I play statistics. That's what technical analysis is all about, is studying charts, looking at past patterns. Maybe this new next high will just rip. I really don't think so, for all the reasons I've been citing for months now, and so that's it. So if you want to trade it, I don't think the upside potential is worth it, and I would just watch for any type of solid reversal. Now, thing about the stock market too, I'll tell you, this is something I've learned from years of trading. Usually right about the time I start to notice a pretty clear pattern develop, clear pattern emerge, that's about the time it stops working. So if you have everybody else noticing this series of marginal new highs, you have longs position, they're going to stay long or keep buying until we get that high at least. We might not get it. And that would fool the masses, and the market loves to fool the masses. So just keep that in mind. And that's why, again, to me, right now it's a matter of, it's just not worth it on the upside to be, net long the equity markets as a swing or trend position. The risk reward is not favorable, despite the resiliency of the trend. Like I said, again, you want to call it an uptrend, you can call it that, because we're making a series of higher highs, especially from this point here. But the bigger point, like I said, 1.5% gain in the last year. It's mostly a sideways market, and the risk so far during that, this point back here, the risk has been to the downside. That drop was wiped out a lot of people here who probably didn't buy back in until this point here. So if we get another drop like that, they're going to be trapped. Either way, we'll see what the market does. And again, the market is probably going to tip its hat here in the next week or two once those big companies report. And we'll wrap it up here with the small caps. I like to cover IWM from time to time. You have this is a 60-minute time frame, just near-term stuff right here. Pretty clean bearish rising wedge pattern setting up right now on the small caps right here. So I'm drawing out for you. You have the negative divergence right here. You just need to throw in a sell signal, and to be safe, you have a gap right here. I could play around with these lines, put the top of the gap. Not exactly the top, about where I see the most reactions. They're about I call it 154. Even though the bottom of the gap technically is down here, that's where we closed the day before. You have some support there. So let's just say this is a gap right here to be backfilled. And so if that wedge breaks, and looks like we're right on there, at minimum look for a gap backfill and probably a move down here to about that 152.13 level. And again, if we didn't have the big market moving FANG stocks, and they're not in the small cap index, but if they happen to, the market loves what they hear from these FANG stocks over the next week or so, the large caps will most likely drag the small caps up with it, and vice versa. If it goes the other way, this thing's going to play out, and it could play out a lot more for that. So that's what I'm looking at near term. Daily chart is, there's some potential there for the small caps because they have divergent low right here. They've been building positive divergence for a while, but they're really still lagging the large caps. Small caps, like a lot of other things in the stock market, peaked back in 2018. This was a high back here in early September or so of 2018, and we're still well below that, kind of consolidating. The bigger picture is small caps, I think, are waiting for a cue from the large caps as to whether they're going to break to new highs or not. So you're looking at this pretty much all year. This is other than the swoon down into the December lows and then that V reversal right there. You exclude that, this is where the small caps for the last couple of years have done most of their trading. They had one little pop above it, couldn't hold it, fell back down, had that little quick swoon in and out. But again, if you look right here between about 160 to about 145, that's where they've been trading. So it's another, just to me, you step back and really have to view it on the weekly charts, the long-term charts. Here's a market that has stopped going up a while ago. It won't go down, but it's really not going up much anymore either. And it's going to break one way or another sooner or later. And for the small caps, keep it simple. They need to take out 160 to be bullish. There's a little downtrend line there, and if they drop below that range right there, about 144 or so, that's going to be pretty bearish. And I don't think they will stair step down. I think they'll shoot on right past the December 24th lows if that happens. Not right away, but relatively quickly. All right, we'll wrap it up here and see. We'll certainly follow up tomorrow and later this week after we get those earnings reports. This has been Randy Finney with Right Side of the Chart. Hope you enjoyed it.